So in this video, we're going to try to calculate the intrinsic value of Norwegian Cruise Line. And the way we do that is we estimate the future free cash flow of the company and then discount that back to today's dollars. So the first step is we need a market cap. It's 3.563 billion. 3.563 billion. Okay. And now we need a stock price, $13.90. So that implies they have 256 million shares outstanding. Now, I'm going to calculate the future free cash flow of the company, and when we discount it back, we have to divide it by 256 million. And if the estimated stock price is above what it's currently trading at, we consider that a buy. There's value in the stock. It's trading below intrinsic value. But if intrinsic value is below the actual stock price, say it's $5 a share, we shouldn't buy it because the stock price is too high in the market. So keep watching. Maybe you'll learn a few things. I get my information from Google Finance. So the first thing we need is cash flows. Anytime you run a discounted cash flow model, you want to estimate the future free cash flow, because this is the lifeblood of every company, cash. And free cash flow is the cash that's remaining after running the business. And it's pretty much cash from operating activities minus capital expenditures. And you could look at Yahoo or on the 10K or their financials and see how they calculate cash flow from operations. They take the net income number, and then there's depreciation factored in, a lot of stuff. This is how you operate the business. Change in inventory, change in accounts payable. I'm not going to go through the entire thing, but it's definitely good to look at so you understand how that operates. Next, we need net income for the past 4 years. And last is revenue. So they had a pretty nice increase in revenue over the years. It's up a lot from 2016. It went up to 6.5 billion. They have positive free cash flow. So when a company has positive free cash flow, that means the cash they generate from running the business is enough to pay the expenses. When you see a negative free cash flow, it doesn't actually mean they have no cash in the bank. It just means they have to find other sources to get cash. Usually it's more debt to fund the operating business. But this so far looks good. Now we need to figure out that capital structure so we know what to discount the cash flows by. So interest expense of 273 million. So that's the interest they pay on their debt. Now let's see how much debt they have to figure out the interest rate. Current liabilities list the short-term debt or current debt. This is debt due within 1 year. And then non-current liabilities lists long-term debt, which is debt due after 1 year. So they pay 4% interest on the debt. Now, what's their income before tax? See, that doesn't look right. They actually got a refund in 2019. So let's do a different year, because the tax rate should be the same year to year, but we can't figure out too much sometimes from the income statement because they have a lot of deductions and write-offs. But they pay a really low tax rate. We'll take last year's. They had almost $1 billion income before tax, and income tax is only 14 million. So I would need to check the 10K on this, and let me know if you have any comments. I'm gonna just force it to 15% because that's too low of a tax rate, and There's something funky going on there that we should probably dig into a little bit. So even though they pay 4% interest on the debt, it's deducted from their effective tax rate because debt is a write-off. Well, the interest on the debt is a write-off, and the actual cost of debt is 3.41%. Now let's see the cost of equity. We need the beta. That's the volatility of the stock. Wow, that's a high beta, 2.77. So it's pretty volatile. So they're gonna have a high discount rate, 23.59 CAPM. So a blended discount rate, which we call the WACC, is 10.35%, and that's what we have to discount the future cash flows by. So we calculate the future free cash flow. We also calculate a terminal value, which is all the cash flows after year 4. And we discount those numbers by the required rate of return, and we get a PV value of the company of 4.7 billion. And when you divide it by 256 million shares, the stock price is 18.30. That's what we calculate. The intrinsic value of the company, $18.30 per share. So they're trading at a 24% discount because they're trading at $13.90 a share. So they were trading in the 50s above intrinsic value. So why would people pay more than a stock is worth? Well, some people don't know how to calculate intrinsic value, but a lot of people look to analysts, and the reason in the prior years an analyst may have said this was a buy was because they saw a lot of growth for this company, so they saw the future being much better than the past. Now the stock has come down to reality with coronavirus, and now it's trading below intrinsic value, so it's a buy. But does that mean that it's actually a buy? Because you can't look at the past financials, because you also have to consider the future as well. Now, will the cruise line business be successful this year? Probably not. Next year, I doubt it. Who knows when they'll be back to full capacity, if ever, and that's what you have to decide on when buying the stock. And let me know in the comments if you want me to do another video of a different company. Thanks for watching.